A property you purchase with the intent to make a profit from can be classified as an investment property. However, there can be a wide variety of properties within that category. For instance, if you buy a vacation rental you can enjoy for a couple of weeks a year and have it rented out for the other 50 weeks of the year, it is a source of income and can be classified as an investment property. In reality, investment properties can be broken down into several kinds. What is an investment property? Properties can be broken down into three categories. The first is the residential property that is also your residence. In legal terms, and specifically in the context of tax, you must know that your residential property is a unique entity. Just like any other property, the price of your home or your apartment or whatever kind of residence you have will increase. However, this increase in price will not be considered a form of earning or business. The second home people have, or the second property they purchase, is seen as different. Some people will rent out this home, maybe in the form of a vacation rental or in the form of a property that is full-time on rent. Under different accounting terms and legal frameworks, second homes are also looked at differently. Generally, there is no limit to how many second homes you can have, as these are all places you use on a temporary basis and they can be scattered all over the world. The key thing here is that you actually use this home from time to time, but also use it as a source of revenue. The third kind of property is what is known as an investment property, and that is one you have purchased purely for the sake of making money from it. This can be in the form of the rent that you charge from the property or the appreciation in value from holding the property for long periods of time. In this third form of property, it is important to note that houses bought to flip are not considered investment property. People who buy a property and sell it within a short amount of time for profit, or those that redo the property and then resell it, are not considered people in the investment property business. Investment properties are those held for a long time. Another thing to note is that accountants, tax professionals, or real estate agents will all define these properties differently. When looking to secure a loan or some kind of financing for an investment property, it can be quite challenging to define whether you are buying a second home or an investment property. When it comes to raising capital for such a property, it will always be in your best interest to classify that asset as a second home. When you tag it as an investment property, not only are the rates for the financing going to go up, but you are also opening yourself up to a lot more paperwork, more tax-related concerns, and more legalities overall. Types of investment properties. Real Estate Investment Trusts, REITs. REITs are companies that have complete or partial ownership in large commercial or residential projects and allow investors to purchase a part of that property. These can include malls, cinemas, restaurants, hospitals, or any other large property. Just as you would buy the share of a company on a stock exchange and become a partial owner of the company, you can invest in the shares of an REIT and become a partial owner of the property that they own. The great thing about REITs is that they offer very good returns, and you don't have to carry many risks. When you invest in a company, you are relying on their products or services and the competency of the management team. Anything can change a company's financial situation, but the property is a very stable avenue to invest your money into. Moreover, in most states, REIT firms are bound by law to pay out 90% of their total earnings in a financial year to shareholders. You never really know exactly how much the company earned with other companies, and even though they might be paying a good amount in dividends, it could just be a fraction of the net earnings. Another big advantage of investing in an REIT is liquidity. If you buy a single property of the same value, it could take you weeks, months, or even years to sell that asset and earn a profit. The price could fluctuate a lot during this time, and you will constantly be at risk. With REITs, you have a share you need to sell, and it is much easier to find someone who is going to buy your shares than it is to find someone who can buy the entire property from you. Moreover, the transactions are verified through the stock exchange, so you can be sure that you are investing your money in a reliable avenue. When you are buying directly off the street, you will have some concerns about the assets being legal and correctly represented. With REITs, everything is critically evaluated, certified, and allowed to be sold to the public. Crowdfunding platforms. Crowdfunding platforms are similar to REITs in that they allow a group of investors to invest in a certain property. The difference is that the crowdfunding platforms are usually home to assets that are not available on the open market. These are unique, high value properties that will nearly always guarantee a very good margin of return. The drawback is that these platforms are often only available to a certain clientele. Some are open to the average customer, but the best in the business only deal with a small number of clients. The other thing to look out for is the payment terms. Crowdfunding platforms have their own way of managing funds. For instance, some may not allow you to withdraw your investment for a 5-year period. Even if you need the money, it becomes inaccessible. Before diving in, you need to be aware of a few nuances to crowdfunding platforms. Raw land. If you look up the property investment portfolio of some of the richest people in the world, you will notice that the highest chunk is allocated to raw land. This land is left as it is, like a jungle or whatever form it is in, and in many cases, it is used for agriculture. Some of the biggest landowners hold over 1 million acres of raw land. Raw land can be used in a variety of ways, and this dictates the kind of investment a person makes. One of the ways is to buy farmland and then use it for agricultural purposes. The other popular method is to buy raw land in an urban setting and then develop the land into homes, commercial centers, buildings, etc. This is the preferred approach for land expected to have a high value in the future. Developers will acquire large chunks of the land well beforehand and either start developing it or just hold it and then sell it later in smaller pieces to other developers. Before stepping in to buy raw land to hold or develop, it helps to understand that real estate market, the common building techniques, and relevant regulations. This kind of investment requires a lot of capital and can often take years for the investment to fully mature. Residential real estate. Under the residential property types, there are countless kinds of assets you can consider: apartments, villas, multi-story houses, farmhouses, duplexes, and many more. The most common investment in this kind of property is a single-family home. Single-family homes tend to be the fastest-selling kind of asset, and they are available at many different price points. Within the residential properties, many different strategies can be used. For instance, some people prefer to buy homes and sell them as they are for a small profit margin. Such investors rely on a high volume of sales to keep things going. Then some people prefer to redo the home and sell it for a premium. Some people prefer to buy and hold properties and sell when the overall market value has gone up. Also, different markets have their own dynamics. In some places, one strategy is more effective than the other. A completely different strategy might have to be employed in other markets, so it is important to understand the dynamics of the market you are dealing in. One of the reasons why this is a preferred property to invest in is the tax breaks you can get. For commercial properties, not only is the investment higher, but there is also a higher tax and more legalities that need to be looked into. Commercial real estate. Under the commercial real estate umbrella, there are offices, retail spaces, hotels, agricultural land, and many other kinds of assets you can consider. Commercial real estate property is a great investment because not only does the value of the property itself rise, but it can also be used to generate an income as they are. For instance, parking lots are large pieces of land that require close to no capital to set up, and they also increase in value as the city expands and the area gets more populated. The only downfall to commercial investments is that they are far more expensive than residential investments and have a higher level of risk. Also, they can have a rather heavy management expense, and if a person isn't familiar with the business itself, it can get quite difficult to manage. However, all these challenges mean that this is a less competitive market as not everyone has the capital to finance such an investment, and neither are many willing to take on the long process of owning and managing a commercial property. Financing this asset. Financing investment property is a challenging part of this business. Generally, residential properties have the lowest cost of financing. A loan or mortgage for a typical house will have a low interest rate and will only require 5% of the cost of the structure as a down payment. Second homes have a slightly higher rate of interest and require a down payment in the 5% to 10% range of the entire cost of the structure. Investment properties have the highest rate of interest and require 20% to 30% of the property's value as a down payment. Similarly, other fees related to the financial services will be higher, such as the origination fees, service charges, and any additional servicing costs that you incur. If you can decide what you are looking to buy the property for and how you intend to use it, this can help you get a more cost effective financing solution. For instance, if you are buying a residential home as an investment property, it can be better to show the lender that this will be a second home you will use to earn income. Later on, when you think you are getting enough of a margin on the home, you can sell and benefit from the increase in real estate value. Another challenge is finding the right lender, because different institutions have different classifications of a second home and investment homes classifications. For instance, some banks will count your second home as the first residential purchase after the house you live in full time. If you were to buy a third home, it would not be considered a second home. For others, if you are earning a rental income from the second home, it is considered an investment property and not a second home. So, the way that an investment home is defined will influence how easy or difficult it is for you to get financing. Common mistakes and tips for success. The biggest mistake new investors make is that they make emotional decisions. Just because a property is appealing to you at an emotional level, it doesn't mean the market will reflect this fact. Save yourself from overpaying or underselling your property by not developing an emotional attachment to the asset. Buying an investment property is not like buying a home you will live in. It is not based on your personal preferences, rather on what will earn you more money in the long run. Don't settle for the first property you find. Give yourself time to explore as many options as possible before you finalize investing in a single property. When buying an investment property, make sure you do enough research. Look at the different options you have in your area. Look into what others are asking for similar properties. Look into what will earn you more money in the long run instead of just focusing on the best deal you are getting right now. In many cases, spending a bit more on your initial investment will help you get a better return later, even if that means going over your current budget. Financing an investment property can be a tricky business, so it is always a good idea to have more than you think you will need for the initial down payment. Also, consider looking into different financing options instead of just sticking to your local bank. If you are making multiple property purchases from the same bank, it will end up getting more expensive. When you go to a new bank, you will get far better rates, even if it is an investment property. Commercial real estate. Commercial real estate is a kind of property used exclusively for profit making activities. In some areas, a residential property can also be used for commercial activities. For instance, opening an Airbnb in a house you don't use. This way, a residential property can also be commercial real estate. However, it usually refers to a building or piece of land used exclusively for business. Commercial real estate is a broad term that can include many different kinds of properties, and those properties can also be further divided into specific kinds. Commercial property and commercial real estate refer to the same kind of property. What is commercial real estate? You can make money from a little retail store, a warehouse, a hotel, a hospital, even a theme park. While all these properties are classified as being commercial properties, there are major differences among each. Commercial real estate can be divided into 8 different kinds in legal terms. Office. Office buildings can be small spaces that only accommodate a single business or very large buildings that house several businesses and hundreds of people. Office spaces are also differentiated based on where they are located. Some will be urban office spaces, such as the large skyscrapers and high-rise buildings found in the city's main areas. Others will be suburban office spaces, which are usually smaller buildings or a collection of buildings grouped together in spaces like corporate parks. Office buildings can be used by a single tenant or multiple tenants using the same space. Many of these buildings are made to accommodate the unique needs of the business that will be functioning there. Also, these buildings are broken down into 3 classes. The top tier is Class A buildings. These buildings are quite new. They offer all the best amenities and services. They have excellent accessibility and are usually large structures. An example will be the latest skyscraper in the middle of the business district. They are quite expensive and are only usually by large corporations or top-tier local businesses. Class B buildings are the second grade of office spaces. These are buildings in the middle price range and also offer a good mix of services and locations. However, These buildings tend to be a little older than Class A buildings and are located a little outside of the city's main business areas. These are slightly more affordable than Class A buildings. Lastly, there are Class C buildings. These are usually structures that are more than 20 years old and offer very basic services in comparison to Class A structures. At the same time, these are located in less busy areas of the city or regions, where the traffic has now diverted to large business centers. These are the most affordable office spaces available. In some cases, these can also be buildings that are in a good location but in poor condition, and the available services are limited, so it is priced much lower than others in the same vicinity. Retail. Retail commercial real estate refers to all the different businesses we use frequently as retail clients, such as restaurants, retail stores, medical stores, grocery stores, and other service providers such as hairdressers and dentists. The retail segment of commercial property is the largest section of this industry, and there are a lot of variations within it. For instance, a small mom and pop shop at the end of the store is also a commercial retail property, and the mega mall in the heart of the city is also commercial retail property. There are many different metrics used in pricing a retail space, including things like the footfall, the size of the space, the age of the building, the appropriateness for a certain kind of business, the number of tenants, and the history of the area. There are single-tenant commercial retail spaces that can be very large, even larger than many retail spaces that are multi-tenant spaces. For instance, big box stores such as Walmart or the Home Depot are huge areas occupied by a single business. The value that these businesses bring is so potent that they can even increase the property prices of other commercial and residential lands around it. Multifamily. The multifamily commercial property encompasses all kinds of property that falls outside of the single-tenant framework. This can include things like apartments, condos, co-ops, and townhomes. Just like offices, the different kinds of multifamily accommodations are also broken down into different classes. Some of these buildings can be difficult to identify. For instance, apartment buildings come in many forms, sizes, and qualities. Some apartment buildings are dedicated to a certain kind of clientele, such as student housing buildings, senior housing facilities, subsidized housing buildings, and even very expensive designer apartment buildings. In some cases, multifamily housing is classified based on the kinds of amenities present on the property. For example, walk-up buildings are 4-story or more that don't have an elevator. Generally, installing an elevator is not possible in a building that was not designed for it, so this kind of permanent classification remains until a major structural change is made or the building is rebuilt. When it comes to pricing these kinds of commercial properties, a host of metrics are used. As an investor, a person is looking for something that will give them the most value for the money they invest, either in the form of the rental value or the increase in the property value. This can be quite hard to judge because of the many factors that determine the price. Industrial. Industrial properties are those used for either manufacturing or for storage. Some of these buildings can also serve a dual function of being production or storage facility and also be an office space for the business. Industrial properties can be heavy manufacturing, light manufacturing, warehouses, or hybrid facilities. In bulk manufacturing real estate, the property is completely customized to meet the needs of the business. For instance, iron mills need everything from the ground up to be built specifically to meet their needs. Light manufacturing facilities are used primarily for their space. In such a property, a business will install its own machinery. When their operations are over, they will remove all their capital investments and leave the building in the same condition as when they got it. Warehousing is also a commercial activity in which the facility can be completely customized. For instance, a cold storage unit, or it can be used as is, such as a simple warehouse where things only need to be placed on racks. Flex industrial buildings are those in which there is some kind of manufacturing happening or part of the building being used for storage, while the rest is used for operations of the business itself. This is considered when constructing the building itself, as other things are needed, such as parking space, entry for non-commercial vehicles, security, emergency facilities, and others. The perfect industrial property will be located outside the urban zones and will be located close to the main transportation routes. Sometimes they will be standalone buildings, and they can be grouped into industrial complexes in other cases. Hotel. These are buildings designed specifically for hotels. There are many different kinds of hotels, such as those that only offer accommodation, those that have restaurants, those that have a shopping center, and those that offer additional amenities, such as a private golf course. All parts of the property are considered part of the commercial real estate the business is using. These different properties are grouped in different ways, but they are all exclusively used by either a private hotel or a hotel chain. Special purpose. These facilities don't fall into any of the other commercial real estate groups. For instance, if you have a large private storage facility, an amusement park, or a public parking lot, this will be categorized as a special commercial property. Land. Commercial land refers to land used for agriculture, vacant land, a private airstrip, and all other forms of land not used for housing and accommodation. There are many different kinds of commercial land. The most popular is agricultural land. People will buy large portions of agricultural land and then lease it out to farmers rather than farming themselves. Mixed use. Mixed-use commercial properties are pieces of land or buildings used for a mix of things. For instance, a large building that has apartments on the top floor, retail shops on the ground floor, and maybe a public pool in the basement. Similarly, some businesses buy a manufacturing facility far out from the city with on-site accommodation for employees. These are some of the mixed-use commercial properties. How can you start? When buying a commercial property or investing in a commercial property, you must understand the nature of the business conducted over there. If you don't know how the business works, it will be difficult to estimate whether or not you are paying the right price for the property. There are two ways you can start a commercial property business. Direct. Direct investment is when you purchase a property using your own capital, or capital that you have borrowed, and you become the landlord of that asset. This can be done as a group where you and a few others get together to put up the money for a commercial property purchase. This is usually done by companies or high net worth individuals, as it can require a considerable amount of capital. However, what's more important is knowledge. Commercial property can be difficult to understand, and the market dynamics can also change quite frequently. If you know the commercial property sector in your area, you know about the commercial construction regulations. If you don't, you can hire people to manage this for you. Indirect. Indirect investments in real estate include things like real estate investment trusts, REITs, in which you buy a portion of the property or share of the property, much like how you would buy shares in a company. The landlord or the REIT firm will sell shares of a larger property they own, and you will benefit in the form of the dividend earnings. Similarly, there are exchange-traded funds, ETFs, you can invest in, which will give you partial ownership over commercial property, and you can earn dividends from this investment as well. This is a great way to start investing in commercial property, as you can start with a much smaller investment and save yourself from many risks. Moreover, you won't have to go through lengthy processes to secure an investment for your purchase, and you can get started quickly. Sub-niches within commercial real estate. In commercial real estate, there are 3 ways people make money. The most common is in the form of an investor. A person has money they want to invest, and they buy property. In previous chapters, we have gone into detail about how you can invest in real estate and make money from this activity. The other option is to be a broker. You might buy a property and then sell it, or you might negotiate the transaction between a buyer and a seller and make profit from the trade. This is another popular strategy and one we have discussed previously in regard to both residential and commercial real estate. The third and possibly the most profitable of the strategies is the role of a developer. In this case, you buy land or buildings, further develop them into high-value properties, and then sell them to other buyers. This process involves a lot of capital and knowledge about the different construction regulations, but the payout is well worth the effort. If you plan on becoming a developer, your best bet is to start with someone already in the business. This way, you can get a good understanding of how things work and what you need to keep an eye out for in your region. Your money will also be protected as you have a joint interest with a well-reputed developer. Common challenges in commercial real estate and tips for success. The commercial real estate climate is constantly changing. It is very sensitive to international and national level events, and there are many trends you need to be aware of to make a profitable decision. The best strategy is to have a very accurate understanding of your ideal customer and to understand how you can protect yourself from changes in the environment. The other challenge is finding tenants. Businesses do not like changing their premises very frequently. Another question most new investors think about is whether they should buy an old building or a new one. Each has its own pros and cons, and it depends on what the market requires and how much money you have. In many cases, buildings in a good part of town are rebuilt several times over the course of several years because the market demand for that locality is very high. In other places, very popular locations go out of fashion when a new area gets developed. Oftentimes, a lot of the decisions you make are going to be dictated by the amount of disposable capital you have. While money is important in real estate, it is not the only asset you need. Many people started with very small investments, bought small properties, and grew into large commercial developers who now do their own housing projects. Ideally, start small and grow as you learn. Lease options. In the previous chapters, we discussed all the different ways you can invest in real estate. However, some people don't own a property they can use to rent it to others, but they still dream of buying their own house. They may be unable to afford a down payment or even have a credit profile to realize that dream. A good alternative is to consider a lease option. But what exactly does that entail? This chapter will explain what it is, how to make money from it, and which mistakes to avoid in lease options. What are lease options? A lease option is an official agreement between a renter and a property owner, where the renter is allowed to purchase the property during or at the end of the lease period. This contract prevents the owner from selling the property to someone else. At the end of the lease period, the renter must purchase the property as agreed or forfeit their rights to do so. This agreement is also known as a lease-to-buy option, lease with the option to purchase, rent-to-own option or agreement, or simply rent option. The renter pays an option fee in advance and monthly rent for the duration of the rental period. Whether monthly or upfront, all the fees paid go to the down payment at the end of the lease period if the tenant decides to buy the property. If not, they lose all the money paid to date and have no legal liability toward the owner. This means the owner can't force the tenant to purchase the property. Lease options are considered a great alternative to people who want to own a home in the future, but with today's market price. The loss here is minimal compared to taking a bank loan or applying for a mortgage. The option fee paid up front is usually 1% of the property's price, which suits people who can't afford a down payment at the moment or are still developing their credit profile. Many property owners choose the lease option because they can't sell their property. This option appeals to first-time buyers, single people, young couples, or other segments who can't afford to fully pay for a home. The owner benefits from the monthly premium set at a higher rate than the standard rent. If the tenant didn't end up purchasing the property, the owner keeps the premiums and places the property back on the market. Lease option requirements. Lease options might be the only way for some people to own their homes with relatively low risks. So, what's in it for the property owner? The owner gets to charge the tenant a higher rental fee because they forfeit their rights to sell the property to another buyer within the duration of the agreement. The duration of the lease period varies according to the agreement between the owner and renter, which usually ranges from 1 to 5 years. This gives the renter the chance to extend the lease option if they think they need time to fix any faults in their credit rating, which is essential to qualify for a mortgage. The contract must include the property's price in advance or mention that it's subject to change at the end of the lease period. The property's value will probably change during the lease period, so it's better to accommodate potential price fluctuations in the contract. If your sale price is based on the property's current market value, you may end up losing on potential profit if the market price increases by the time of the sale. However, a lease option still guarantees you gain some profit now and throughout the entire duration of the lease. In addition, if you increase the sale price too much, this may chase away buyers because it may be difficult for them to secure a mortgage in case they have to pay more than the property's value at the end of the lease period. A premium, also called rent credit, is a portion of the standard monthly rent, which is calculated as a percentage by the owner, around 30% to 50% of the rent. If the tenant chooses to purchase the property, this premium is added to the down payment at the end of the lease. For instance, if the agreement states the premium is going to be 50% of the rent, which is $2,000, then $1,000 will go to the down payment every month. If the lease option lasts for 5 years, the down payment will amount to $60,000 at the end of the lease period. The renter may pay a valuable consideration, which is a one-time offer to the owner. This is usually a cash payment or a valuable item given to the owner, which is non-refundable and won't go toward the down payment. The consideration could be a token fee or a percentage of the property's price, usually 5 to 7%. The purpose of this fee is to ensure that the owner won't sell the property to another buyer. The contract should include which of the parties is responsible for repairs, maintenance, insurance, utilities, homeowners association fees, and other expenses. For instance, the tenant should pay for the renter's insurance and utilities, while the owner should pay for the homeowner's insurance and general maintenance. The owner has to make sure the house is properly maintained, especially the essential systems like heating, water, and electricity. Everything should be stipulated in the contract so that each party knows their legal rights and responsibilities. It's best to document the possible outcomes of the lease option in the agreement. Both parties should agree on what will happen if the tenant purchases the property before the end of the option or if they change their mind. Since the owner is compromising their rights to sell the property during the contract period, it's only fair for them to keep all the premiums and option fees paid by the tenant. However, some owners decide to return all or part of the premiums to the renter. Some owners require a security deposit, just like in a regular rental agreement. If the tenant didn't pay the rent on time, they might be evicted and, of course, lose all the paid premiums and fees. The renter should ensure the property won't be subject to foreclosure. Before signing the agreement, potential buyers usually request a home inspection and an appraisal contingency. The appraisal is to re-evaluate the property's value, which may decrease at the time of sale. How to make money using lease options. There are 3 main ways to make money with the lease option strategy. The first method is receiving the non-refundable option fee from the tenant to secure the agreement. The second method is gaining the monthly rent difference between what you receive from your tenant and what you pay to the original property seller. The third method is when you sell the property to the tenant at the end of the contract period. Let's assume you find a house with a lease option. The seller sets the house's value at $100,000 with a duration lease period of 5 years and a monthly rent of $1,000. The lease agreement states that all of your rent goes to the down payment at the time of sale. The next step is to find a tenant to take a lease option on your house. You set the property price at $150,000 and charge them a monthly rent of $1,500 for a lease period of 2 years. The tenant will give you a 10% option fee of $15,000, which you can pay toward the purchase price if you want. You agree with the tenant that 30% of their rent goes to their down payment. After 2 years, your tenant would either buy the property or forfeit their rights, in which case you still profit from their premiums while paying the original seller. If your tenant changes their mind after a year, you can find another buyer and repeat the same process. In this example, you profit from the $15,000 option fee and the $500 difference between the rent you pay to the seller and the rent you receive from the tenant every month. When the newest tenant decides to purchase the property at $150,000 after 2 years, you will use a portion of that amount to pay the original seller. Bear in mind, you were already paying them $1,000 every month as per the original purchase contract. After 3 years, you would have paid the original seller $36,000 with $64,000 to go. Now, your tenant paid you a $15,000 option fee, and the agreement states that $10,000 goes toward their down payment, plus 30% of their rent, which is $450 every month for 2 years, amounting to $10,800. The tenant paid a total of $20,800, and they still owe you the remaining $129,200. When you pay the original seller the remaining $64,000 you owe them, your profit becomes $65,200 in 2 years. This makes it an incredible investment from a single house without having to invest your personal money. Common mistakes to avoid. When structuring your lease option contract, there are a few common mistakes to watch out for. The first one is being unclear about the tenant's identity to the contract. You need to write their full legal name as per their national ID or driver's license, and it should be written at the beginning and at the end of the agreement. It may seem like an obvious aspect of any contract, but many landlords face trouble when getting their tenant's name wrong, especially if they end up in court due to a breach of contract. Another common mistake is not performing a thorough market analysis to find out the rent ranges in your area. If you don't have a specific average, you'd either overprice your property and never appeal to potential buyers, or underprice it and end up losing money. You need to reevaluate the rent every new tenant to stay up to date with market trends. Many property owners overlook the customizable aspect of a lease option agreement. In the contract, you're entitled to write any clauses you want in terms of changes in the interior design, allowing smoking or pets in the house, type of repairs and utilities payments required from the tenant, and any other aspects you choose. Writing these points officially gives the tenant some set rules to follow until they purchase or leave the property at the end of the lease period. However, you need to be reasonable with your requirements and not overcharge the tenant for extra repair fees or the security deposit. It's important to abide by state laws on these points. Another mistake to avoid is not including what happens if the tenant doesn't pay the rent. If you don't add the consequences of a late payment, you'll end up with more of them, and you won't be compensated in court. Write the details of the eviction process, late fees, and grace period next to the agreed upon rental rate in the contract. Don't forget to include the lease period with the exact dates so the tenant knows when they can move into the house and when they're expected to leave if they decide not to purchase it. Tips. Now that we covered the most common mistakes, here are a few tips to use in the lease option strategy. Use clear terms in the agreement like a non-refundable option fee, the tenant, and the landlord, and avoid using vague terms like the seller, buyer, or the tenant's nickname. Make sure to write the current standard rent in advance to avoid having to recalculate what it used to be a few years ago when it's time to renew the lease or sell the property. It's always a good idea to get a professional legal consult from a specialized real estate attorney who can ensure you have a solid agreement to protect your rights as a tenant to the original seller and a landlord to your current tenant. Keep the agreement duration as short as possible, preferably a year, to be renewed by the same tenant or ended so you can lease the property again to a new tenant at the upgraded market price. The short-term contract allows you to change some of the terms to accommodate for an increase in property value, for instance. Maintain a tenant-landlord relationship as opposed to a buyer-seller relationship until the tenant officially purchases the property. This entails taking a security deposit and paying your homeowner dues like insurance, taxes, and general repair costs. Make sure the tenant has a fair chance to follow through on the option without charging them an extremely high rent credit or overcharging them for rent. They have to read and understand all the terms of the agreement and give them full disclosure of how you're making your money from the lease option. This chapter discussed lease options, their legal requirements, and how to make money using them. Make sure you conduct in-depth market research before attempting to invest in a lease option. If you keep in mind all the common mistakes and tips outlined in this chapter, you'll be able to benefit from your investment and repeat this strategy with various properties. REIT and mortgage notes. Investing in REIT is an easy option you can add to a real estate portfolio to diversify it. This chapter explains the meaning of REIT and the different types you can consider. It also highlights the measures you can take to invest in REIT and the challenges you are likely to encounter. The last section discusses mortgage notes and how you can make money from investing in them. What is REIT? A real estate investment trust, REIT, is an organization that owns, operates, and finances real estate. REITs are modeled after mutual funds, and they pool capital resources from several investors. Individual investors can generate dividends from real estate investments without buying, managing, or financing any properties. Most REITs are traded publicly like stocks, and this makes them liquid. How REITs work. REITs invest in different forms of real estate, such as apartment buildings, data centers, hotels, cell towers, offices, medical facilities, warehouses, and retail centers. Diversified REITs can have different types of portfolios, and investors can buy and sell them like stocks. A company should comply with specific provisions of the Internal Revenue Code to qualify as an REIT. It should also meet the following requirements: invest about 75% of total assets in cash, real estate, or treasuries. Pay a minimum of 90% of its taxable income as shareholder dividends every year. Obtain at least 75% of its gross income rentals, real estate sales, or interest on mortgages. The company should be a business taxable as a corporation. A board of directors or trustees should manage the company. It must have at least 100 shareholders. The company should not have more than 50% of its shares controlled by 5 or fewer people. REITs account for about $3.5 trillion in gross assets, and the publicly traded equity is about $2.5 trillion. Types of REITs. There are mainly 4 types of REITs, which include the following: equity REITs. These are publicly traded equity REITs that own income-generating real estate like apartment complexes and office buildings. Mortgage REITs. These provide financing for income-generating real estate by offering mortgages or backed securities, as well as earning money from investment interests. Public non-listed REITs. Liquidity may be limited on these REITs since they are registered with the SEC, but they do not trade on the National Stock Exchange. Private REITs. These are exempt from SEC registration and not available on stock exchanges. These are available for institutional investors. If you want to invest in an REIT, you should first check if it is listed on the stock exchange and buy shares as you will do in any other public entity. However, private REITs are a bit complicated since they are limited to accredited and institutional investors who can access the fund directly. They also come with higher minimum investment requirements. Why invest in REITs? There are different reasons why you should consider investing in REITs. The primary reason for venturing in REITs is that they provide you with exposure to real estate such as residential, retail, or commercial without purchasing any property. You can invest in this industry without facing financial challenges often encountered when one purchases different properties. REITs can help you earn high dividends since companies are required to pay about 90% of their taxable revenue to the shareholders. More importantly, you can diversify your portfolio with REITs. When one segment plunges, you can leverage the other one. This can go a long way in helping you protect your investment. Problems of investing in REITs. While REITs play an essential role in your investment portfolio, they also come with challenges you should know. REITs don't provide much in terms of capital appreciation, since they must pay about 90% of their revenue generated to the investors. Therefore, only 10% can be reinvested to the REIT to purchase new properties. Other REITs have higher transaction and management fees. There are potentially high taxes, since the income distributed to investors is viewed as ordinary income instead of qualified dividends. REITs can experience huge swings as a result of volatile economies. The other challenge is lower liquidity, especially those not listed on major stock exchanges. Investors may not be able to sell a lot of shares at some point, and they will be forced to wait. Private REITs come with more risks, which is why many investors publicly list investments. The table below highlights the pros and cons of investing in REITs. Pros: liquidity, diversification, transparency, attractive, risk-adjusted returns, stable cash flow. Cons: low growth, subject to market risks, dividends are taxed like regular income, potential for high transaction and management fees. The Securities and Exchange Commission, SEC, recommends that you should be wary of individuals who try to sell unregistered REITs. All REITs must be registered with the SEC. It is important to verify all publicly traded and non-traded REITs using the SEC's EDGAR system. You also need to review quarterly and annual reports to make informed decisions. What are mortgage notes? A mortgage note is a special type of contract since it is a loan secured by real estate. This is a document you should sign when you close your home, and it should reflect all the terms of the agreement between the lender and the borrower. The house you want to buy should undergo the underwriting process if you want to apply for a mortgage. The lender will decide if you are creditworthy And they will also check the value of the home you want to purchase to see if it is enough to secure the loan should you default. A mortgage note is a document that shows how you intend to repay the loan and that you will use your house as collateral. It includes the following details: down payment amount, the total amount of the mortgage loan, payments required, terms of interest, fixed or adjustable interest rate, repayment penalties. A mortgage note is usually accompanied by a promissory note which outlines the terms for paying back the lender. It states the financial details of the loan's repayment, such as the method of payment and interest rate. A promissory note also outlines the procedure that will be followed if the borrower fails to repay the loan as agreed. Therefore, it is essential to ensure that all legal details on the promissory note are accurate. To avoid misunderstandings that can compromise your loan, you should go through all the details to understand the terms and conditions. This document is primarily designed to protect both the borrower and the lender. How can you buy and sell mortgage notes? A holder of a mortgage note or seller can sell it without the buyer's consent. If you are a mortgage or real estate investor, starting a mortgage note buying a business can be a profitable investment. The main benefit of selling a mortgage note is that the seller will receive one single lump sum payment, and they do not need to wait for the loan to be repaid. This removes the risk of non-payment. The seller will no longer have to collect their payment from the lender or manage the loan. It is essential to remember that this can only be the case when the mortgage is not sold in full. If the investor partially sells the note, they will get a smaller lump sum and receive regular payments after. How can you make money off mortgage loans? Lenders can receive payment in multiple ways, and home buyers can also save a lot of money on their mortgages. The different ways mortgage lenders can make money include origination fees. Lenders charge origination fees of up to 1% of the loan value since they use their funds when they extend mortgages. This fee typically increases the overall interest rate and total cost of the property. When the origination fee is added to the annual interest rate, the total amount to be paid on the loan will increase. Yield spread premium. Mortgage lenders can use funds from depositors and borrow from bigger financial institutions at lower interest rates. Yield spread premium is the difference between the interest rate charged by the lenders to the homeowners for providing a mortgage and the rate the lender will pay for replacing the borrowed money. For instance, the lender can borrow funds at 4% interest. Then, they will extend the mortgage at 6% interest, which means they will earn 2% interest. Discount points. Discount points can help you buy down the mortgage's interest rate. One discount point is equivalent to 1% of the mortgage amount, and this helps lower the monthly loan payments. This will save the homeowner money for the life of the loan. The type of lender, type of mortgage, and market conditions determine the extent to which the interest rate is lowered. Closing costs. The lenders charge closing fees on loans on top of application fees, origination fees, loan lock fees, and underwriting fees. A home buyer should carefully read the list of fees they should pay for the mortgage. What common problems can you face, and how do you avoid them? Mortgage loans come with different challenges you should know. The following are some of the issues you should familiarize yourself with before you approach a lender. Adjustable rate mortgages. Adjustable rate mortgages are everyone's dream since they provide low interest rates for the first 5 years. With this type of loan, you can buy a house you want and enjoy lower and more affordable payments. However, the interest rate will revert to the market rate after 5 years, which can be higher. If you can take equity from your home loan to refinance your credit, then life will be easier for you. When the prices of houses drop, borrowers often find themselves facing the challenges of refinancing their current loans. Therefore, you should shop around to find the best lender. No down payment. A down payment increases your home's equity, and it also helps lower the interest rate you will pay for the loan. A borrower who puts more money into down payment is likely to make their mortgage payments than those who put little money for the same. A borrower who owes more money is likely to walk away and leave unpaid loans, which will lead to foreclosure. Liar loans. This kind of loan does not require a lot of verification and documentation since the lender will consider the borrower's income, stated expenses, and assets. As the name suggests, the borrowers tend to lie, and they inflate their income to get bigger homes. However, problems often arise when the buyer gets the property, but they cannot make constant loan payments. As a result, they will fall behind in their loan repayments and end up facing foreclosure. Reverse mortgages. A reverse mortgage is offered to people above 62 years old, and they can use the equity out of their homes to get a steady income. The income can be paid as a lump sum or in a steady stream of payments. However, a reverse mortgage has many drawbacks since it consists of high upfront costs such as mortgage insurance, origination fees, appraisal fees, title insurance, attorney fees, and miscellaneous fees. The fees can consume the equity, and this kind of mortgage can have implications on your dependents, although you will still retain the title. The dependents will need to pay off the loan. Longer amortization. Mortgages with 35 to 40 years are constantly rising in popularity, and they allow the buyers to get bigger homes. However, this loan can make sense to buyers in their mid-20s. When you are over 40, getting this kind of loan does not make any sense since you may not live beyond 80 years. This will leave your kids with a loan they may struggle to pay off. You will have less equity in your home if you get a loan with longer amortization. Additionally, these loans come with higher interest, allowing lenders to benefit from the extended period a borrower will take to repay their loan. Exotic mortgage products. Many lenders come up with different loans to help prospective homeowners to fulfill their dreams of buying properties. For instance, an interest-only loan allows you to live in the home and make interest payments only. Other types of loans allow the borrowers to decide the amount they want to pay on their mortgage. However, the challenge is that the big principal payment will be due after a specific period. Instead of building up equity, a borrower can be building negative equity. If you want to venture into the real estate sector, there are different options you can consider. You can operate in this sector without investing a lot of money in buying properties. REIT investment is one way of investing in the real estate sector without first buying properties. Before starting your business in this sector, you should also know the significance of mortgage notes.